9% last month from a year ago, and that is slightly bigger than the expected decline of 39.1%. Exports to China down 29.7% from a year ago, falling at a faster pace than the year to April. Well, let's take a look at how oil is shaping up. Asia's side currently moving further away from that $70 per barrel level, off 1% or 70 cents at $68.54. Well, after the U.S. markets closed, crude trimmed gains following the American Petroleum Institute's bearish report for last week's demand. According to the API, domestic crude stocks fell 72,000 barrels last week, and that is less than a Reuters forecast for a 1 million barrel draw. Well, later today, we're going to get the Energy Information Administration's own inventory report. And for more on the oil market movements, we're joined by Jonathan Kornefeld, Director of Asia at Hudson Capital Energy. Well, thank you for coming along today. So I guess the expectation now, now of course our eyes are on the EIA report. Is it going to be pretty much in line with what the API said?
Well, if it is in line, then I think you're going to see a lot more bearish pressure on the market. In the last week, we've dropped about 10%. We've come from the low 70s to the high 60s. We had a bit of a rally yesterday, but that was nipped in the bud by the API numbers. You saw a draw in crude that was smaller than expected, and a build in gasoline inventories that was bigger than expected. So it added a lot of pressure to the market. The gasoline complex is what really pulled the entire energy market higher for the last 2 months. Now we're seeing with these surprise builds in gasoline inventories, it's not really going to have the energy. Gasoline's not going to have the fresh legs to pull the market up again. So I think what you're going to see is the market trending lower, but not too much volatility. I wouldn't expect us to get back above 70, and the long-term trend higher is still in place. So I think there's a lot of support around 65, 66.
Jonathan, it's Becky in London here. Should we necessarily read through into the demand picture from these figures that we've had out?
Well, sure. You know, demand is still somewhat anemic. I mean, in unleaded gas is still the only one that has demand that is not terrible compared to the last couple of years. It's still over 9 million barrels a day. I think in terms of overall commodity demand, there was some sunshine yesterday. We saw a slight uptick in steel demand. POSCO and ArcelorMittal said that they were going to be increasing their steel production. That had an impact on investor sentiment, which is what caused the dollar to decrease, and some more funds went into crude oil and some other riskier assets, which is why we saw the crude rally. The API numbers came out and said, well, hold off a little bit here. The demand's not really there. Crude sold back off again.
Now, the interesting thing, though, we are, of course, heading into the summer driving season in the United States. But if you take a look at the unemployment rate, you know, 500,000 people are losing their jobs on a monthly basis. And people are not necessarily going to feel that giddy about traveling. So, I mean, isn't that a pretty good sign of what the demand picture will be like?
Well, Americans will still take their vacations. They're just not going to fly to the Caribbean. They're not going to fly to Hawaii. They'll drive to the shore. They'll drive to the lake. So there still will be demand in gasoline. And I would expect the demand in gasoline to stay there. It's just not going to be overly strong, but it's not going to look like some demand pictures that we've seen in some other commodities right now.
Jonathan, we have also on the supply side seen some real geopolitical concerns, particularly around Iran and the extent to which that could spread, or the effects of which that could spread. Have we seen that really reflected in the oil price yet, do you think?
Not at all. Not at all. I think whether or not the election controversy happened in Iran, we would still be trading exactly where we are right now. The oil flowing out of Iran is still flowing at the rate it normally does. There's been no upset there. But of course, anytime you have any sort of civil unrest in one of the largest producers in the world, that is cause for concern. But oil now has become a bit of an asset class, and there's not a lot of attention being paid to the fundamentals right now. It's more being looked at as an inflation hedge rather than what's going on in Iran.
Now, this growing view that a lot of floating oil storage facilities out, and you just can't keep on stockpiling them, and part of that is created by what China's doing. And so some people think that oil prices might actually collapse.
I really don't think there's going to be much of a collapse. An interesting thing happened last week when oil was still above $70, trading around $72, $73. A lot of the speculative longs, more than 20%, got out of the market. So what that tells you is as the market starts to drop off, you're going to see some funds, you're going to see a lot of speculators getting back to the market and buying as we dip if we go below 60.